Okay, so you want to own a pawn shop. The plan is straightforward. Buy used items for pennies on the dollar, put them on a glass shelf, and sell them for a massive retail markup. That is the classic buy low, sell high blueprint playing out in your head. And honestly, it is not a bad plan. Stand inside a local shop on a busy Tuesday morning and watch the chaos unfold. A guy slides a flat-screen TV across the counter, while the next person in line hands over a heavy gold ring. The owner hands out a few crisp bills, takes the items, and carries them into the back room. You watch the sheer volume of physical inventory coming in at rock-bottom prices for 10 minutes, and you think, this must absolutely print money. Here is the problem. You are looking at the 10 minutes a week that lies to you the most. A pawn shop isn't really a retail business trying to flip second-hand goods. It is a highly liquid, collateralized micro-lending business that just happens to have a retail storefront attached to it. So why is it that a customer never returning to claim their TV or gold ring, which sounds like a guaranteed retail profit, is actually a pawnbroker's absolute worst nightmare? This is the business that looks like a simple trading operation on the surface, but hides one of the most unforgiving, cash-hungry liquidity traps in modern finance. To understand what it actually takes to open one of these shops, you have to completely discard the idea that you are opening a retail store. If you want to sell t-shirts or coffee, you sign a lease, buy some inventory, and wait for customers to hand you money. A pawn shop operates in exact reverse. You are not building a traditional store, you are building a heavily fortified, highly regulated neighborhood bank. And banks require cash. Massive, liquid, easily accessible piles of cash. This brings us to the single largest barrier to entry in this industry: your initial loan capital. Before you even think about turning on the open sign, you need a bare minimum of $50,000 to $200,000 in liquid capital sitting in a safe, ready to be deployed. In the pawn industry, this is often referred to as street money. When you open your doors on day one, people are not going to walk in looking to buy things. They are going to walk in demanding cash for their collateral. Every single loan you write drains your working capital. If a local contractor brings in a set of industrial power tools and needs a $500 loan to make Friday payroll, that is $500 gone from your vault. If 10 people come in later that afternoon with gold chains, laptops, and guitars, you might hand out $4,000 in a single afternoon. If you run out of cash, your business effectively ceases to exist. You cannot tell a desperate borrower to come back next week because you are waiting on a check to clear. The entire value proposition of a pawnbroker is immediate, unquestioned liquidity. Therefore, this $50,000 to $200,000 reserve is not a safety net. It is the fundamental raw material of your daily operations. Because you are sitting on a mountain of street money and highly fungible physical assets like gold and diamonds, your storefront must be built like a literal fortress. The security infrastructure will demand an upfront investment ranging from $20,000 to well over $100,000. You are not just buying a standard commercial burglar alarm. You need a TL-15 or TL-30 rated solid steel vault, which alone can cost upward of $10,000 and often requires you to pour a reinforced concrete floor just to support its sheer weight. The display cases on the showroom floor cannot be standard retail glass. They must be crafted from shatter-resistant polycarbonate. You need high-definition, 24/7 monitored camera systems with off-site cloud backups, covering every square inch of the floor, the back room, and the exterior. Why is the industry standard for security so aggressively high? Because of the unique legal reality of the items in your vault. When someone pawns a Rolex, you do not own that Rolex. You are legally holding it in trust as collateral. If your shop is robbed and that watch is stolen, you cannot just shrug and tell the customer it is gone. You are legally liable to replace the item or compensate the borrower out of pocket. A weak security system doesn't just invite theft, it invites catastrophic, business-ending legal liability. Then, there is the psychological aspect of the retail floor. Even though your main profit engine is lending, you cannot open a pawn shop with empty shelves. An empty store looks illegitimate, temporary, and desperate, which instantly drives away high-quality borrowers. To establish credibility, you must pre-stock the showroom floor before you ever unlock the front door. This initial seed inventory, comprising wholesale electronics, refurbished tools, and a baseline of jewelry, will cost you an additional $10,000 to $50,000. This inventory exists purely to create the visual illusion of a bustling, successful retail operation, encouraging walk-ins to trust you with their valuable family heirlooms. Finally, you must pay the toll to the government. Because pawn shops bridge the gap between retail, banking, and the second-hand goods market, they are heavily regulated at the municipal, state, and federal levels. Initial licensing, compliance, and legal structuring will cost you a minimum of $5,000. You will need a specialized pawnbroker's license, a precious metals dealer permit, and a second-hand dealer license. Furthermore, you are required to purchase a local surety bond, a type of upfront insurance that protects the municipality and your customers in case you break the law, commit fraud, or go bankrupt. You also have to pay to integrate your point-of-sale software directly with local police databases, automatically reporting the serial number and description of every item that crosses your counter to ensure you aren't unwittingly fencing stolen goods. When you step back and look at the ledger, the reality of opening this business comes into sharp focus. Between the massive vault of street money required to fund your loans, the bank-level security infrastructure, the seed inventory to fill the shelves, and the maze of bureaucratic licensing, your total cost of entry ranges anywhere from $50,000 for a bare-bones rural setup to well over $500,000 for a fortified urban operation. These initial capital requirements are the highest hurdle to entry, and they strictly dictate exactly how many loans you can originate. And to maintain the strict narrative structure of this analysis, these initial capital figures will strictly remain in this section and will not be repeated again. What do you think is actually going through a pawnbroker's mind when you place a $5,000 Rolex or a professional-grade DSLR camera on their glass counter to secure a $1,000 loan? If you are like most people, you believe in a very predictable, almost predatory script. You assume the owner is silently praying that you fall on hard times, miss your repayment deadline, and permanently forfeit the item. You believe they are looking at a guaranteed $4,000 retail arbitrage profit just waiting to fall into their lap. Customers usually walk through the doors with their guard up, fully convinced they are stepping into a wealth extraction trap designed to strip them of their assets. To clear away this fog of misconception, we have to present the single, overriding truth that governs this entire financial ecosystem. That paradox is this: the pawn shop does not want to own your item. Yes, you read that correctly. They absolutely loathe the idea of keeping your collateral. To understand this seemingly absurd reality, you have to peel back the retail veneer and examine the true market dynamics driving this business model. A pawn shop is not a second-hand retail store disguised as a lender. At its core, it is a microcredit institution issuing high-yield, short-term collateralized loans. Just like any other financial institution on Wall Street, the blood pumping through their veins is not physical merchandise, It is pure liquidity. Their real, sustainable profit is derived entirely from the recurring cash flow of monthly interest payments, not from a one-time speculative retail markup. Let us look closely at the contract structure. When you pawn that watch for $1,000, you agree to pay a monthly or weekly finance charge. Let's assume the combined interest and storage fees come to 10% a month. If you return faithfully every single month to hand over a crisp $100 bill just to extend the loan and keep the watch out of the display case, you have transformed yourself into a passive, safe, and highly predictable money printing machine for the business. The marginal cost logic here is absolutely flawless. The operational cost for an employee to accept your $100, print a fresh receipt, and update the computer system is essentially zero. The profit margin on this recurring extension transaction approaches 100%. As long as you keep paying the interest, their initial $1,000 is continuously breeding new money without them ever having to lift a finger to sell the watch, which remains resting safely in the darkness of their steel vault. But what happens when you default, abandon the contract, and disappear into the wind? From an amateur's perspective, the shop just hit the jackpot. From the perspective of a seasoned economic operator, this is the exact moment their lean, optimized financial model begins to break down. The first catastrophic consequence is the sudden freezing of working capital. The entire foundation of microlending relies on the velocity of money. A liquid $1,000 stack of cash can be lent out, recovered, and lent out again multiple times a year, generating compound interest with every single cycle. However, the moment you abandon your collateral, that flexible working $1,000 is instantly calcified. It becomes trapped inside a heavy block of stainless steel and sapphire crystal named Rolex. Until that specific watch is successfully sold to a new buyer, that $1,000 cannot be deployed to the next desperate borrower who walks through the door. It sits dead on a glass shelf, generating exactly 0% yield. In a business that survives entirely on continuous capital rotation, frozen working capital is a slow, agonizing death sentence. The second reason defaulting is a nightmare is the sudden explosion of market risk and operational bloat. The moment the loan term expires and the asset legally becomes the property of the shop, the owner is violently shoved out of the comfortable chair of a financier and thrown into the brutal, high-risk trenches of a retailer. They are no longer collecting passive yield. Instead, they must now pay staff to polish the item, re-authenticate it, dedicate expensive showroom floor space to display it, photograph it for online listings, and pay wages to employees who have to stand there and haggle with stingy bargain hunters. Furthermore, they are immediately exposed to the ruthless volatility of the open market. If the forfeited item is consumer technology, like a sealed MacBook, its secondary market value evaporates by the day, as Apple prepares to announce a newer model. If the collateral is jewelry, the shop is suddenly at the mercy of global gold and diamond spot prices. Any downward fluctuation in these commodity prices directly cannibalizes the supposed retail markup everyone mistakenly assumes is so lucrative. By the time the item is finally sold, which could easily take months of sitting idle, the sunk costs, overhead, labor, and the devastating opportunity cost of that buried $1,000 have swallowed nearly all the potential profit. To confirm that this is not just economic theory, we must conclude by looking at hard, empirical industry data. If the true profit engine of this industry relied on seizing assets and flipping them for a premium, we would see massive liquidation rates across the board. The shops would be actively trying to push borrowers into default. However, according to statistics from the National Pawnbrokers Association, NPA, In the United States, an average of 80% to 85% of all pawn loans are fully repaid, and the items are successfully redeemed by the original owners. This overwhelming majority is not a market accident. It is the exact destination that this entire industry is meticulously engineered to reach. Pawnbrokers intentionally price their loan-to-value ratios conservatively, typically offering only 25% to 50% of the retail value, precisely to create massive psychological and financial leverage that forces you to come back for your item. They do everything in their power to ensure you return to pay the interest, because to them, an item permanently sitting on their retail shelf is never a victory. It is a catastrophic failure of cash flow. To truly grasp the catastrophic danger of frozen working capital, we cannot just look at a small neighborhood pawn shop holding on to a few unredeemed flat-screen televisions. To see this paradox play out at its absolute most destructive logical conclusion, we have to scale the numbers up to the institutional level. We have to look at a company that attempted to rewrite the fundamental rules of collateralized lending and was completely destroyed by the exact liquidity trap we just outlined. This is the story of Borro, a high-profile financial technology company that learned the hard way that a pawn shop is only as strong as its ability to convert physical assets back into liquid cash. In its early years, Borro was hailed as a revolutionary disruptor in the financial sector. They aggressively rebranded the traditional, often stigmatized pawn shop model into what they called luxury asset-backed lending. They were not dealing in power tools or cheap jewelry. Borro targeted high-net-worth individuals, entrepreneurs, and business owners who needed massive, immediate cash injections. If a millionaire needed a bridge loan to fund a new business venture, they could hand over a garage full of Aston Martins, a collection of fine art, or a vault of Patek Philippe watches to Borro, and receive hundreds of thousands of dollars in liquid capital within 24 hours. By the years 2013 and 2014, Borro was operating at the absolute peak of its powers. Their growth metrics were staggering, and they were the darling of the alternative finance world. They had successfully originated tens of millions of dollars in luxury loans and had successfully attracted the attention of major institutional investors. During this peak 2013-2014 period, Borro raised over $200 million in capital to fuel their aggressive expansion. They had essentially built the ultimate high-end pawn shop, backed by Wall Street-level funding. But in the financial world, having an enormous war chest of capital creates an intense, unrelenting pressure. You have to deploy it. Capital sitting in a bank account does not generate yield. It must be loaned out to generate the monthly interest payments that investors demand. And this is where the first microscopic cracks in Borro's foundation began to appear. The luxury pawn market, while lucrative, has a natural ceiling. There are only so many wealthy individuals willing to pawn their Ferraris or Picasso paintings at high interest rates. Borro had a massive mountain of cash to lend, but they were running out of luxury assets to lend against. To satisfy their investors and keep the loan book growing, the executive team made a fateful, strategic pivot. They decided to expand beyond highly liquid luxury goods and began accepting collateral that belonged to an entirely different asset class: real estate. On a spreadsheet, this pivot seemed entirely logical. Real estate holds massive intrinsic value. If you want to deploy $5 million in a single afternoon, writing a loan against a luxury estate is infinitely faster than finding 50 people willing to pawn $100,000 diamond rings. But by stepping into the property market, Borro fundamentally violated the golden rule of the pawn industry. They abandoned highly liquid, easily transportable collateral for the most illiquid, immovable, and legally complex asset class on Earth. The trigger event for Borro's ultimate demise was practically inevitable. It started when several of their high-net-worth clients, who had taken out massive loans secured against luxury properties, suddenly defaulted. Following the standard operational procedure of a collateralized lender, Borro seized the assets. But a luxury mansion is not a Rolex. You cannot put a mansion in a display case and sell it to a walk-in customer the next afternoon. When those clients walked away, millions of dollars of Borro's flexible working capital were instantly vaporized and transformed into bricks and mortar. The company was now holding massive illiquid physical properties that they could not liquidate fast enough to replenish their cash reserves. The paradox of the pawnshop clamped down on them with terrifying speed. Not only were they no longer collecting the massive monthly interest payments they had projected from these loans, but they were now actively hemorrhaging money just to maintain the collateral. They had to pay exorbitant property taxes, insurance premiums, maintenance costs, and staggering legal fees just to navigate the foreclosure and liquidation process. Because real estate takes months, and sometimes years, to sell on the open market, Borro's capital rotation completely ground to a halt. The velocity of money that their entire business model relied upon dropped to zero. This created a devastating domino effect. Borro itself was not lending its own money. They were lending money they had borrowed from massive institutional financiers, most notably Victory Park Capital. Even though Borro's clients had stopped paying them, Borro was still legally obligated to make massive interest payments to their own institutional backers. The company found itself trapped in an inescapable financial vice. Their cash was buried inside unsold real estate. Their operational costs were skyrocketing due to the burden of managing those properties, and their debt obligations to their financiers were compounding daily. They desperately tried to offload the real estate, but fire-selling luxury properties in a distressed situation almost guarantees you will take a massive loss, destroying the very principle you were trying to protect. The final consequence of this strategic error was total, systemic failure. Unable to convert their seized collateral back into liquid cash, and unable to meet their debt obligations, the company's internal financial structure collapsed inward. The severe liquidity crisis proved fatal, leading directly to the company being forced into administration, the UK legal equivalent of bankruptcy, in November 2017. Borro did not fail because they lent money to the wrong people, nor did they fail because the underlying assets lacked value. They failed because they forgot what business they were actually in. They believed the illusion that holding valuable assets was the path to wealth, completely forgetting that in the microlending industry, physical collateral is a liability, and liquidity is the only thing that keeps you alive. To understand how this business actually survives day to day, we must strip away the grand systemic failures of institutional giants like Borro and look closely at the brutal, unglamorous mathematics of a standard neighborhood pawn shop. You have built your fortress, you have stocked your vault with street money, and your doors are open. Now, you are playing a relentless, ticking clock game against your own ledger. The fundamental financial formula that governs your survival can be stated in simple words. Revenue minus fixed costs equals your break-even point. While that formula sounds like Standard Business 101, the way those numbers behave inside a pawnshop is entirely unique. To see the true picture, we are going to open the Profit and Loss (P&L) statement. This is the only time we will look at the internal operating math, because understanding these specific numbers is the only way to comprehend the crushing pressure of this business model. Let us begin with the enemy, your fixed costs. Every single month, before you make a single dollar of profit, you are bleeding cash just to keep the operation alive. First, there is the rent for a highly visible commercial retail space, which easily runs you $6,000 a month in a decent metropolitan area. But rent is just the beginning. Because you are holding hundreds of thousands of dollars in other people's valuable property, your commercial insurance premiums are astronomical, often adding another $2,000 monthly. Then comes payroll. You cannot hire minimum wage retail clerks. You need highly trained staff who can spot a counterfeit Rolex, test the purity of 14-karat gold using nitric acid, and accurately appraise a vintage Gibson guitar, all while managing tense negotiations with desperate customers. A lean team of 3 specialized pawnbrokers and a manager will easily cost you $12,000 a month in wages, taxes, and benefits. Add in the cost of high-security utilities, armed transport services, mandatory software subscriptions that link directly to police databases, and local tax compliances, and you are staring at a minimum of $4,000 in miscellaneous operational burn. Add it all up, and your neighborhood pawn shop has a fixed monthly overhead of roughly $24,000. That is $24,000 that evaporates from your bank account every 30 days, regardless of whether 100 customers walk through the door or 0. So, how do you generate the revenue to feed that $24,000 monster? You do it one microscopic transaction at a time. Let us look at a complete, perfect numerical example of your core revenue engine. A customer walks into your shop holding a heavy 18-karat gold necklace. After weighing the gold and checking the daily spot price, your pawnbroker determines the necklace has a current open market resale value of exactly $800. You do not offer them $800. Remember, you are a conservative lender heavily mitigating your risk. You offer to disburse a cash loan of $300. The customer accepts, handing over the necklace as collateral. You hand them 3 $100 bills. Now, let us examine the contract they just signed. For that $300 loan, the customer agrees to pay a combined interest and storage fee of $50 per month. On paper, generating $50 from a $300 investment in just 30 days yields a staggering 16.6% monthly return. If annualized, that is a 199.2% return on deployed capital. In traditional finance, charging a 199% annual percentage rate would be considered aggressive loan sharking and completely illegal. However, state regulators explicitly carve out legal exceptions for pawnbrokers because these are microloans with massive default risks, and the physical storage of collateral justifies the exorbitant fees. A 16.6% monthly yield sounds incredibly lucrative. When you look at that single transaction, you feel like a financial genius. But this is where the reality of the P&L statement brutally crushes the illusion of easy money. Let us connect your impressive 16.6% yield back to your terrifying $24,000 fixed monthly overhead. If your average profit per loan is $50 a month, how many of those gold necklace transactions do you need just to cover your fixed costs? You take your $24,000 overhead and divide it by the $50 fee. The answer is 480. You need exactly 480 active, paying loans every single month just to reach your break-even point. You need 480 individual humans to walk into your store, borrow money, and faithfully return 30 days later to hand you a $50 bill, just so you can pay your rent, your insurance, and your staff, leaving you with exactly $0 in personal profit. But let us dig one layer deeper into the mathematics of liquidity, because this is the exact moment most novice pawnbrokers realize they are trapped. To have 480 active loans of $300 out in the world, you must physically disburse that cash. 480 multiplied by $300 equals $144,000. This means you must have $144,000 of your precious, liquid street money actively deployed in the hands of strangers, completely draining your vault, just to generate enough monthly interest to cover your baseline survival. If you want to actually make a comfortable living, say, taking home $10,000 a month in pure personal profit. You need an additional 200 active loans. That requires deploying another $60,000 of capital. This P&L reality completely redefines the business. You are not celebrating a 16.6% yield. You are frantically managing a massive, high-volume loan book. You are constantly sweating over the status of your deployed capital. If 20 of your customers decide they no longer want their gold necklaces and default on their $300 loans, you instantly lose $1,000 in monthly interest revenue. Your fixed costs do not care that your customers defaulted. The $24,000 overhead remains exactly the same. You now have to waste time liquidating 20 gold necklaces just to recover your $6,000 in principal, all while scrambling to find 20 new borrowers to replace the lost monthly yield. The math of a pawn shop is a breathless, never-ending race. It is a constant, high-wire balancing act between the relentless, unchanging weight of your fixed operational costs and the fragile, unpredictable velocity of your deployed capital. You are managing a multi-$100,000 micro-bond portfolio, where the coupons are paid by desperate people standing at a glass counter. And if the volume of those payments drops for even a few weeks, your break-even engine will rip the business apart from the inside. To truly grasp the fragility of this business model, we must remove human error from the equation and look purely at market forces. We will build two parallel business scenarios based on the exact same initial cost structure. In both of these scenarios, you are running the exact same pawn shop. You have the exact same highly trained staff, the same fortified steel vault, and the exact same monthly operational overhead. You have deployed your capital carefully, and you have adhered strictly to conservative loan-to-value ratios. Your management skills have not changed one bit. The only difference between these two scenarios is an external macroeconomic force that you have absolutely zero control over. The good year, the golden equilibrium. In a good year, the global commodity market is stable, or perhaps trending slightly upward. When a customer walks in to pawn a heavy 14-karat gold bracelet, the spot price of gold is sitting comfortably at a high, predictable baseline. You appraise the bracelet, calculate its melt value, and issue a cash loan that represents 40% of its current market worth. Under these stable conditions, the psychology of the borrower works perfectly in your favor. The customer knows that their gold bracelet is highly valuable. They know that if they default on their relatively small loan, they will lose an asset worth more than double what you handed them in cash. Therefore, the incentive to return, pay the monthly interest, and eventually redeem their collateral remains incredibly strong. During this good year, your loan book performs exactly as designed. The velocity of your money is excellent. You disperse cash, you collect lucrative monthly interest payments, and the physical collateral rarely stays in your vault past its contract expiration date. Your working capital is constantly rotating back into your hands, ready to be deployed to the next customer. You are operating a smooth, efficient micro-lending engine. The uncontrollable variable. But pawnshops harbor a massive, often invisible systemic vulnerability. To understand this weakness, we introduce an uncontrollable variable, a sudden drop in the price of gold. Why is gold so critical? Because in a standard neighborhood pawnshop, you are not mostly lending against laptops, guitars, or power tools. Those items are bulky, they depreciate rapidly through technological obsolescence, and they take up massive amounts of shelf space. Instead, the ultimate undisputed king of pawn collateral is precious metal. It is compact, it does not age, and its value is universally recognized. Because gold makes up over 50% of collateral, a price drop instantly turns profitable loans into bad debt. The bad year, the value collapse. Now, let us examine the bad year. Everything inside your shop remains identical, but halfway across the world, a central bank unexpectedly raises interest rates, causing investors to dump precious metals. The global spot price of gold plummets by 25% over the course of a few short weeks. You are sitting in your office, looking at a vault full of gold chains, rings, and bracelets that back hundreds of active loans. You did not make a single bad underwriting decision when you wrote those loans last month, but overnight, the mathematics of your entire portfolio have inverted. Consider the psychology of the borrower now. A customer who borrowed $400 against a gold chain that was previously worth $900 had a strong incentive to return. But with the sudden price crash, the true secondary market value of that chain has plunged to $500. By the time they factor in the $60 in accrued interest and fees they owe you to redeem it, the total cost to get their item back is $460. The customer does the math. Why would they pay $460 in cold, hard cash to retrieve a chain that is now barely worth $500? They don't. They make the entirely rational economic decision to walk away. They keep your $400 principal, and they abandon the collateral. Suddenly, the paradox we discussed earlier violently activates. Your shop experiences a massive wave of simultaneous defaults. Your highly liquid working capital is trapped inside hundreds of depreciating gold chains. Because the global price of gold has crashed, you cannot even sell these items at a premium on your retail floor. You are forced to box them up and ship them to a wholesale refinery to be melted down just to recover whatever cash you can. Because you are liquidating into a down market, the payout from the refinery barely covers the initial principal you lent out, completely wiping out the expected interest revenue you needed to pay your fixed operational costs. The absolute profit gap. The terrifying reality of this business is how quickly this single uncontrollable variable dictates your survival. We conclude by comparing the absolute profit gap between the 2 years using specific numbers. In the good year, operating with stable gold prices and high repayment rates, your shop's capital rotated efficiently, generating a healthy net profit of $120,000 for the year. In the bad year, operating with the exact same staff, the exact same overhead, and the exact same initial capital deployment, the sudden collapse of gold prices triggered a wave of defaults, forced liquidations, and frozen capital. Without changing a single internal operational procedure, that year ends with a net loss of $35,000. The absolute profit gap between a thriving business and a failing one was a staggering $155,000. This massive financial chasm was not caused by theft, poor management, or a lack of retail foot traffic. It was caused entirely by a microscopic shift in a global commodity index that instantly transformed the physical assets sitting quietly in a steel vault from a secure financial safety net into a suffocating anchor. So, if the neighborhood pawnbroker is constantly walking a terrifying high wire of liquidity risk, who actually wins in this industry? The answer lies in the entities that play by an entirely different set of rules. The true winners of the collateralized lending game are the massive, publicly traded pawnshop chains and the institutional private equity firms that provide their funding. While an independent, single-location operator is entirely bound to the limited physical cash sitting in their singular steel vault, corporate behemoths are backed by the endless depth of global capital markets. They do not face the same paralyzing liquidity traps because they possess the ultimate financial weapon: massive geographic and asset class diversification. Consider the uncontrollable variables. If a sudden, localized economic downturn or a sharp drop in gold prices triggers a massive wave of collateral defaults in a specific region, an independent owner might immediately face insolvency. But for a corporate chain operating 2,000 storefronts across multiple countries, that localized commodity loss is easily absorbed. They simply offset the regional deficit using the massive, steady stream of interest revenue generated by general consumer loans in another time zone. Their working capital is never truly frozen. It is highly fluid, constantly being reallocated across borders to wherever the yield is highest and the risk is lowest. Furthermore, these institutional players have the sheer scale required to negotiate entirely different terms for their street money. A standalone shop must often rely on expensive local commercial bank loans or the owner's personal savings to fill its vault. Conversely, a multinational chain can issue corporate bonds at incredibly low institutional interest rates. They borrow Wall Street money for pennies and lend it out at the micro-retail level for dollars. In this ecosystem, the independent owner is fighting a daily, desperate battle against illiquid physical assets, while the corporate chains have successfully transformed the gritty, unpredictable pawn business into a mathematically bulletproof, globally diversified hedge fund. Let us go back to that busy Tuesday morning we talked about at the very beginning. You are standing in the showroom, watching the flat-screen televisions, power tools, and heavy gold rings steadily pile up on the fortified glass counters. The initial illusion was that you were watching a masterclass in second-hand retail. A ruthless, highly profitable machine designed to absorb cheap physical goods and spit out massive, guaranteed retail markups. But now, you can see the invisible, unforgiving ledger operating right beneath the glass. You understand that every seized television is actually an operational liability. Every heavy gold ring is a ticking clock tied to global commodity prices, and every unredeemed item on the shelf represents a catastrophic failure of the business's fundamental mathematical engine. The true battle is not fought on the retail floor with bargain hunters. It is fought in the thin margins of the loan book. The ultimate survival of a neighborhood pawnbroker does not depend on the intrinsic value of the physical assets they hold securely in their vault. It was never about how many second-hand items you could successfully buy for pennies on the dollar and flip for a massive retail premium. It is entirely about how incredibly fast you can keep your liquid capital rotating in and out of your safe before the unpredictable external market inevitably turns against you. Those glowing glass display cases are not a triumphant trophy room of successful retail acquisitions. They are a stressful graveyard of stalled, frozen capital. The next time you walk past a local pawn shop, do not look at the heavily guarded merchandise sitting idle in the window. Look at the people walking through the front door just to pay their monthly interest. Because in the brutal, cash-hungry economics of collateralized microlending, merchandise is a dangerous illusion, and liquid cash in motion is the absolute only thing that keeps the fortress from collapsing.